Let's bring in Troy Gayeski now to talk a bit more about the markets. He's the co-CIO over at Skybridge. Troy, let's start with what's happening, not in the equity space, but in the crypto space. I know something that you follow closely. We were just chatting in the break about how, anytime Elon opens his mouth, everyone kind of pays attention to whatever it is. And I guess for, the coin guys last night, it wasn't great.
Yeah, I got to check my notes. Did something happen in crypto the last 24 hours? I'm not really quite sure what you're talking about, but let me get back to you on that one. No, but on a more serious note, look, as we've said many times, if you have any exposure to crypto, even Bitcoin, which is by far and away the least volatile, you have to be prepared for these 20 to 30% pullbacks. But if you step back, from 100 feet or 1,000 feet, think of the macro environment. Stanley Druckenmiller, who respect a great deal, was articulating this the other day. You're in an environment where you have unprecedented monetary stimulus still. We're still growing money supply at a 16 to 18% annualized pace, roughly double nominal GDP growth. We have budget deficits as far as the eye can see. If you have any concern about storing value in an easily transmittable medium, now is definitely a time to still consider owning Bitcoin, not only for its return prospects, but for its potential to protect you against never-ending currency debasement. I think the debate on whether inflation will actually show up and stick in the economy is very real, but the debate that money supply continues to inflate assets and debase global currencies has been settled really for 30 years. And every cycle, it gets worse and worse. It takes more and more money supply to drive lesser and lesser economic growth, which in turn debases a currency and inflates assets.
I'm not going to get into the discussion, the philosophical discussion about fiat versus crypto at the moment, Troy, but let's pause and just note the opening bell, of course, is ringing. Volunteers of America doing the ringing this morning. And we find ourselves once again in the kind of funny position of at the opening bell for stocks in the U.S., we're talking crypto. But I do want to ask you another question about it. Given what you were just saying, were you guys adding last night as we were seeing crypto go down? Were you talking to the funds that you guys invest in and saying, guys, on this price drop, you might want to get in a little more here?
Yeah, so we actually were not. We've committed to limiting our exposure to 5.5% at cost, which we fully sized in early December. And now we're going to enjoy mark-to-market gains and periodically mark-to-market losses that will continue to benefit of our investors. But we were actually not buying last night. But we do think for people that are looking to accumulate positions that already don't have meaningful exposures to the portfolio, we're still mid-cycle in the halving cycle relative to timing. We talked about the money supply and macro backdrop. And look, adoption continues. I mean, obviously, Musk's statement was a setback. Many believe, including our founder, Anthony, that, he's going to focus more on providing clean energy to crypto miners over the next, 3, 6, 9, 12 months as a way to, help grow his solar business and storage business. But in terms of looking for entry points, we hit that 21 week moving average, exponential moving average last night. We're trading between the 50 to 100 day. So if you're not willing to add here, basically what you're saying is that you're either fully sized like us, or you think that this cycle is going to be roughly half as long as the last cycle in a macro environment that's far more accommodative. And we just don't believe that. We think in this macro environment with continued adoption that we'll ultimately see higher prices as the year goes on.
Troy, as someone that is trying to build a business in cryptocurrency, as you are at Skybridge, do you just pull all your hair out when the CEO of an electric car company comes out with a tweet and sends prices plunging overnight? I mean, what's the conversation like inside your company when something like that happens?
Well, Myles, I got to be honest, I lost most of my hair last March, as you can see by my receding hairline. But on a serious note, look, obviously we're closely following both the positive outcomes. One of the most stunning to me was, I believe it was 2 Fridays ago, when the Bundestag, passed a bill to allow up to 20% of German public funds to invest in crypto. And we all know that Germans are the ultimate hard money people. There's also a motivation to build a fledgling tech industry there because, Germany's really sore about being left behind by both the U.S. and China. But we also follow the negative. And clearly, when you have someone that comes out and commits to holding or hodling, I should say, sorry, to confuse my verbiage in the crypto space, commit to hodling and then say, hey, you're going to use it for transactions and then walk back from that and use it to, or say it's because of the energy consumption, when I think we're all aware that the energy consumption for Bitcoin today is still a fraction of what goes into gold mining, not to mention all the harmful chemicals and the labor constraints in gold mining, and a fraction of a fraction of a fraction of the legacy banking system. It is a bit frustrating, but again, you have to live with the reality of a volatile asset class, and volatile asset classes don't go straight up. They have setbacks even in bull markets, as we know for stocks or Amazon or any meaningful transformative technology has setbacks even in the bull period. But it's definitely more fun when it's up 10% overnight than down 10%.
Troy, on Earth 2, where Elon didn't tweet last night, we were going to be mostly talking about inflation. I know you talked a little bit about, kind of the high level money printing that's gone into the system, but let's just kind of go back to yesterday morning where we got that, fastest inflation print, hottest inflation print, however you want to say it, in over a decade. Just curious for your thoughts on that. Certainly the Fed has been clear. They expect that this print and others like it are coming. Do you think the market, though, is going to be as accommodating to this kind of data the way the central bank would like it to be?
Yeah, so if you think back, again, markets are obviously path dependent, right? And the risks coming into this year were initially like, hey, could we really reach escape velocity? Were we going to get additional stimulus? Would the vaccine rollout go well? And then you had the narrative around higher treasury yields, which were negatively impacting tech in particular and growth. But now, obviously, the narrative's turned to inflation concerns. And again, when we step back and look at the long history of inflation in this country, the one point we always focus on in terms of the real economy, right? We talked about asset inflation before and currency debasement, but in terms of the real economy, it's very difficult to get meaningful, sustained above 3% inflation numbers without having sustained meaningful wage gains. And even though we're very pleased to see, McDonald's, you mentioned before on the show, is raising wages, and we hope that more minimum wage hikes will go into place. The reality is that most of the jobs that were not yet recouped are still lower paying. And as they come on board, even at higher wages, will not add to labor or wage inflation. Furthermore, if you look at the 8.2 million jobs that have still not been recouped, and let's just say half of those, although we think that would be dramatically high, but half of those are structural and won't come back, that's still a tremendous amount of slack. And so as we look forward the next quarter or two, right, markets will be gripped with the narrative of, is inflation really going to stick above 3? Is it going to stick above 3? And in the meanwhile, that will lead to more realized volatility, as we've seen. And the disproportionate loser continues to be high growth tech, particularly as money rotates into value and growth. And, those names, many of them, have traded higher multiples still. That being said, if you're focused, right, and you look at those that have tremendous earnings growth, you look at the recent earnings announcements of a Facebook or a Google or an Amazon, you focus on, semiconductor capital equipment like Applied Materials, there are still areas of tech that have good value. And if you think for us specifically, because, I love to talk our book, we've been underweight tech for quite some time and growth. And so we're seeing this as an opportunity to add into weakness after you're having a reset in valuations due to inflation concerns, which we think are somewhat overblown in the real economy.
All right. Troy Gayeski, co-CIO at Skybridge. Always fun, Troy. Thanks for jumping on. I know we'll talk soon.